Yo, what's up, everybody? Today I want to talk about pyramid entries and how they are so powerful in turning a simple 1R, 2R, even 3R trade and multiplying the R multiple, so your profit. How you can multiply your profit without multiplying your stop loss or your risk. Your risk should stay the same or even decrease. So let's take an example from just yesterday, Friday, the 11th of July. Simple strategy, sweeping these lows off the open. So we have a fake move up, 930 candle right here, fake move up, triggers people long, immediately punishes them, stopping them out, triggering in shorts, stopping out everyone who has their stop down here and triggering everyone short that wants to short off the open down here. Price, this is where we want to look for entries because we see the manipulation down here and our drawn liquidity. As you can see, these relative equal highs up here, there's a lot of liquidity up there, so that's where we're heading. So let's talk about how we would pyramid here. So we have a small breaker, we have a low here, high, lower low, close above it here, validates the breaker. So you could enter on this candle as it trades back into it. Let's say we enter there. And just as a safe stop loss, let's just say you had it way down here, right? So that's 34.75 point stop loss. Target right here, 78 points. That's a 2.25R trade. That's not bad if you just took that, but let's see how we could multiply our profits. So you always want to add above your first entry. So anywhere above here is where we would add, but it has to make sense. And the stop loss also has to either decrease our risk or keep it the same. So let's say we are risking, let's say we took 3 contracts here. So that would be about 70 bucks on each, so about $210 risk. Let's just say we're risking $210. So we could also enter over the close of this IFVG, but that would make our risk, I don't know where you would want your stop, either below half or below the bottom, which you could do that, but you just wouldn't be able to add very much. What I would say is wait for this first presented fair value gap to close above, act as resistance, and then as we're trading away, that's where we would enter. So our second entry, let's just say we waited for the close, even though that's a little far away. Let's just say we did that. Then our new stop on our first position would be dragged all the way up to this stop right here for the second entry. So it's basically 2 different entries on the same trade. So this one, the stop is in profit. So we'd be risk free and locking in profit here. This trade could just be the original $210 risk, or you could decrease the risk by a half, however you would want to do it. But let's just say you kept it 210, targeting the same spot. So that'd be a 193 risk to reward trade here. So let's say both of those hit your target. The first trade's profit would be, let's see, 210 times 2.25. Let's grab my calculator here and bring it on the screen. So what was it? 2.25 times 210 was our original risk. So that's 472.5. And then plus our second entry up here would be, what is that? 1.93. So 1.93 times 210 would be 405. So look at that profit off of risking $210. 472 plus 405, you have $877 profit. And that's risking $210. So let's do the math on the risk to reward there. So 877 divided by 210. So you turned a 2.2R trade and basically a 1.9R trade into a 4R trade, 4.2R. So one trade idea, because you think it's going up here anyway, so why not maximize your profits? You can get stopped out sometimes and take a small win or break even, but most of the time, if you're right on your drawn liquidity, you're right on the entries, and you have valid stop loss placement, you can turn these simple 1.5 2R trades into 4, 5, 6R. This was only one pyramid. Let's go over another example in a second on a double pyramid entry. Okay, the second example where we have multiple pyramid entries in the same trade. So let's look at our drawn liquidity here. As you can see, we ray traced into this big down move here. We retraced. Then we manipulated it one last time. And then 930 manipulates this high, triggers us short. Look at all this low resistance liquidity. Look at that one there. You can be taking partials at these levels. But then our final draw is down here. This is very obvious right here, sell side liquidity. So let's zoom back in. Okay, so we open right on this candle, this green candle, 930. Open higher, immediately drop lower. This red box is the first presented fair value gap for Thursday. This is the 10th of July. We create another one, and we close below this series of downward closed candles. That's a breaker, bearish breaker. So let's take off the magnet tool. Let's say we take the short on the breaker, retest right there. Oop, wrong one. Our stop above the first presented fair value gap, that's 25.50. Let's move our entry so we get triggered in there. Okay, our drawn liquidity is there. That's a 4.8R trade. That's beautiful, right? Yes, it is, but since we're right on our drawn liquidity and we can see bearish price action, low resistance, pyramids are going to definitely help us a lot here. So, first entry, it starts to go in our direction, then displaces, leaving a fair value gap. What does fair value gaps do? They retrace into them, and then they trade away if they're still bearish. So we enter here. Our new stop would be above this third candle to be safe. Target back down there, same spot. That's a 3.9R trade. So 4.8, 3.9. Then we have a gap off of this fair value gap. We have another gap. As we can see, price is very bearish. We tap in here. Our new stop is here. So let's look at where our stop has moved from. It was up here, first entry. Then on our second entry, our stop from the first trade is now in profit by, what is that, 41 to 30? That's about 11 point in profit. So we could use the same amount of contracts if we wanted on this trade. Then on our second pyramid, our third entry, it would be 5 points above our second entry. So total, we'd still be in profit, but on this trade, we'd be 5 down. So we could use one less contract on this final entry. Let's just say we did that. Same target, 3R trade. So let's say first entry, we were risking, what was that, like 27 points or whatever. Let's just say we did 3 contracts on this one. We did 3 contracts on the second entry, and then we did 2 contracts on this one. And that means every single pyramid was less risk than the original position. And since we're confident our drawn liquidity is down here, it's basically like, oh, we missed this trade, we enter here. Oh, we missed this one, we enter here. We're keeping the risk the same or decreasing, but our profits, as you will see, is going to be insane. So let's look, 130 points. So 130 times $2 per micro, that's 260, but we had 3 contracts, so times 3. 260 times 3, what is that? 120, 180, so 780? So $780 profit on that first position. Now, let's take it from the second position. So that'd be 94 points. 94 times 2 equals 188. And then times, what was that? 3 contracts on the second one as well. Let's just round it to 190. So that would be 270 plus 300. 570. I believe that's right. So 570 on the second position. And then the third position, this one was 76 points times 2, be 152. Then times 2 contracts, so let's just say $300, just to round it. So 300 plus 570 plus 780. That's insane. So 870 plus 780 would be, wait, what am I doing? So that'd be 16. What am I doing here? 1650, right? Let's do the math quick. 780 plus 570 plus 300, 1650. You turned this first trade 780 into 1650. Now let's look at the risk to reward, which is really going to blow your mind. So the first trade is the maximum risk. So 27. Why did I close that? 27 points times 2 for the micro, $54. We took 3 contracts. So we risked 162 and we made 1650. 1650 profit divided by, what was the stop loss? Or the risk? 162. 162 equals 1650 divided by 162 equals 10R. That's 10R. 10R trade. Just by adding in the logical areas, moving your stop as if it's at your original position, never risking any more than the first trade. 10R, first trade, it would have been 4.8R. So you turned a 4.8R trade idea, which is very logical, and that's definitely my strategy. You turn that trade from 4.8R into 10R by doing nothing. You could even pretend you're just trailing your stop. So as we get in here, moves away, you see it trade into here, you're like, okay, if it invalidates this fair value gap, I want to be out. So you move your stop here, which is where it would be if you entered in this fair value gap also. Then it starts to trade away again, you're leaving another fair value gap. So you're like, yeah, if this fair value gap gets inversed, I want to be out of the trade. So you move your stop. And guess what? That's where you moved your stop on this final entry right here. And then you hold it till your final target. That's just how powerful pyramid entries are.